Many of us work very hard to pay off our mortgages because we all want to retire early, be debt-free, and enjoy the freedom to do what we desire. The pressure to repay a mortgage is something we all feel, yet only some have calculated the exact amount of interest needed to be paid in addition to the principal. Since 1990, the average standard variable mortgage rate in Australia has been 5%. If you have a $500,000 loan, you will have to repay $466,000 over 30 years, almost equivalent to giving the house to the bank for free. And now, with high inflation and interest rates at 6.3%, the same mortgage over 30 years means paying a shocking $615,000 in interest. Many people ask their banks if there is a better way to repay the mortgage, fixed or variable rates, whether to set up specific accounts, but the banks can't answer these questions. 1. Bank staff can't provide financial advice. 2. They might not even know. 3. The advice you need conflicts with banks' interests. So everyday people often blindly choose an option without fully understanding the various loan products and arrangements. But suppose you want to outsmart the banks, take advantage of them, legally reduce taxes, increase investment returns using properties, and pay off your mortgage early. You need to watch this video till the end. So far, there's only fragmented information out there, neither systematic nor in-depth. So after discussing with my loan team, we've summarized 9 ways to help you quickly pay off your mortgage and retire early. This video will save you a lot of money. Hey there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. The logic of paying off a mortgage quicker is actually quite simple. In general, there are 4 ways. 1. Pay earlier to save on interest. 2. Pay more to reduce principal quicker. 3. Lose less by reducing expenses through interest and tax methods. 4. Earn more through financial and investment operations to repay your debt quicker. Of course, bank loan managers or customer service staff will never tell you this. Bank loan managers have performance indicators. It is directly tied to how many loans they write. Bank management typically rotates every 3 to 5 years. The entire bank's internal ecosystem is built around short-term gains, immediate earnings for employees, and shareholder happiness through rising stock prices. So banks look at the short-term only, offering the best products and lowest interest rates to new and wealthy customers. Long-term and poor clients can't access the best loan products. And if the loan manager leaves, they're ignored, like they've lost a connection to the bank altogether. Getting the same low interest rate as new clients within the same bank is virtually impossible for loyal clients. This is known as the loyalty tax in the Australian banking industry. The more loyal and long-term you are as a customer, the worse the bank treats you, with higher interest rate and stricter terms. So many people with mortgage experience choose to do one vital thing every 2 to 3 years, which is one of the most important ways to help you pay off your mortgage more quickly. Number 9. Refinance. A lot of people still don't get it. Why switch banks? Let me break it down for you. Just think about this. Banks are eager to penetrate the market. They're willing to roll out the red carpet for new customers, offering them lower interest rates, better terms, and sometimes even cash back for a few $100 or $1,000. They may even cut down on credit card annual fees. Why, you ask? It's the bank's way of chasing short-term profits and luring in new customers. Try calling your old bank and asking for a reduction in mortgage interest rate. Trust me, they won't care. It's only when you've been approved for a loan by a new bank and informed your old bank that you're leaving that they may finally start talking to you. If you're making big money, go directly to the bank manager. If it's small money, you absolutely need a mortgage broker. The big earners who own businesses with a turnover of tens of millions of dollars each year are the VIP customers any bank manager would love to be close to. When there's a good policy or loan product, you will be the first to know. But for most ordinary people like us, it's best to consult a loan broker, as they know the different loan products from various banks and can help you choose the best one, unlike bank staff who will only push their own bank's loans. However, loan brokers are also driven by self-interest. Their commission is split into 2 parts, an upfront fee and a trailing fee. The upfront fee is paid by the bank at the time of lending and is detailed in your loan contract. The trailing fee is a small but ongoing amount based on the loan balance. The catch? If within 2 years you switch banks or sell the property, the broker must return the upfront fee to the bank. Now you know why after buying a house, your loan broker might stick to you like glue for 2 years and 2 years only. That's also why many brokers recommend switching banks only after 2 years. Thus, refinancing and switching banks to obtain lower interest rates and better loan terms becomes a method to repay your loan faster. Number 8, use a 100% offset account. If you can use an offset account effectively, you will pay significantly less in interest so that you can finish paying off the loan earlier. When you apply a loan, if you choose to open an offset account, you will notice 2 accounts in your bank's online portal. One is the loan account. For example, you borrowed $1 million. The figure there would be negative $1 million. This means you owe the bank $1 million. And the repayment interest is calculated based on the percentage of that million. Or in other words, the interest base is $1 million, with interest calculated daily. The second account is the offset account. If you deposit $100,000 in cash into it, an interesting thing happens. Your interest base is no longer $1 million. It's reduced by that $100,000 to become $900,000. It's as if you've borrowed only $900,000 from the bank. And naturally, your interest repayment will be less. Additionally, each repayment is deducted directly from the offset account, eliminating any chance of forgetting to pay your mortgage. However, there's one thing you need to be aware of. Make sure to confirm with the bank it's a 100% offset account. Typically, you can only use the offset account feature when having a variable interest rate loan. Number 7, salary to your offset account directly. If the main source of income is your salary, then it's essential, and I mean essential, to have your salary, including bonuses, commissions, paid directly into your offset account. Now you might wonder, why not just keep my salary in my usual account and then transfer the money into the offset account later? What's the difference? The difference lies in the daily calculation of mortgage interest. Deposit money into your offset account 1 day earlier, and you will pay 1 less day's worth of interest. For many people, once their salary hits their regular account, they head out shopping, dining, and spending, and by the end of the month, there might not be much left. When it comes to the time of repaying the mortgage, they may then realize, oh, I should have put the money in the offset account earlier to save some interest. But by then, those days of interest cannot be offset. I treat my offset account as my day-to-day account. Whenever money comes in, it goes straight into the offset account. Need to pay for something? It's paid directly from there. This way, my income enters the offset account sooner and it stays there longer. Stick to this approach in the long run and you will shave off significant amount of your mortgage interest expense. It's a smart habit that could save you a lot in the long term. Number 6, use credit cards wisely. Did you know that your mortgage package might come with a credit card? A lot of people think it's useless. Some don't have any credit cards at all, even with other banks, thinking they will never use them. They even try to cancel the card to save on the annual fee, believing that credit cards are the root cause of overspending. For some, credit cards indeed do encourage spending on things they can't really afford, leading to a trap of high interest repayments. But wait, if used wisely, a credit card could actually help you pay off your loan earlier. Sounds impossible, right? You might be wondering, what's the connection between credit cards and a mortgage? Credit cards offer an interest-free period ranging from a short 45 days to as long as 2 months. That means if you use your credit card for everyday expenses like utilities, groceries, transportation, and entertainment, you can do that for up to 2 months without paying any interest. The money is yours to use, free of charge. Then without a credit card, you might be using your offset account for these expenses. But if you switch to paying with a credit card, that money can stay in the offset account, reducing your mortgage interest while you are not paying any credit card interest. When it's time to repay the credit card, simply pay it off at once with the money from the offset account. This way, you can use bank credit more efficiently, pay less on your mortgage interest, and finish paying off your home loan sooner. But wait, there's more. Besides the interest-free period, some credit cards offer additional perks like frequent flyer miles, rewards, points that can be cashed in, and even free travel insurance. They can also provide purchase protections, ensuring that you get the refunds you deserve. Any one of these advantages makes it worthwhile to own a credit card. So take a moment to rethink that piece of plastic in your wallet. It might just be the secret weapon to financial freedom if you know how to use it wisely. Number 5, diligent money versus lazy money. Money falls into 2 categories, lazy money and diligent money. Lazy money is like a person who's lying there doing nothing productive day in and day out. It just sits there, depreciating over time, much like the money resting in your bank account. On the other hand, we have diligent money, our favorite kind, working hard to earn even more for us. Now you might ask, what about the money in our offset account? Is it lazy or diligent? Well, the answer is, it depends. If this money offsets an interest of, let's say, 6.3%, and if you pull it out to invest, but your return rate is lower than 6.3%, then the money is better off staying in the offset account, working more diligently there. But what if you could find a more efficient way to use these funds? Maybe invest in the stock market, buy mutual funds, or even invest in the real estate market. Since we're all about property here, I won't be talking too much about financial investment. Instead, let's talk about real estate. Suppose you invest this money in the property market and make the right purchase. In that case, your return will far exceed bank interest, leaving stocks and funds trailing behind without a doubt. With some savings in your offset account and after keeping some reserve funds, the remaining money can be invested in another property. Australian property has appreciated at an annualized rate of 7.3% over the past 30 years, beating bank interest. And then there's the ability to borrow up to 80% when buying a house, giving a 4-time leverage to your capital. And then you could reach an annualized return of 28%. After the house appreciates, you can sell it and use the money to make an extra payment on your original mortgage, making it one of the best ways to pay off your mortgage faster. Number 4, pay a little more. One of the most effective tricks to pay off your mortgage earlier is something incredibly simple, paying just a little bit more each month. Let's revisit our previous example, the $500,000 loan with the 5% interest rate and the monthly repayment of $2,685 over 30 years. Now, if you could add just $100 to that payment every month, you'd have it paid off in 28 years. And if you could pay an extra $1,000 each month, you'd be free in just 17 years. So if you can, paying even slightly more every month and sticking with it can have you living mortgage-free far sooner than you ever dreamed. And there is another twist to this strategy. How about making a substantial extra payment all at once? The extra money may come from your year-end bonus, or perhaps the side hustle, or even you've just hit the lottery. That extra fortune you make can go straight into an additional mortgage repayment, not just sitting in the offset account, but paying off the principal. The sooner and the more you can pay extra, the quicker you can pay off your mortgage. Number 3, pay more frequently. It's something so simple yet often overlooked, the frequency of your repayments. Home buyers are all keen on finding the right house, but when it comes to the detail of the loan itself, no one cares as much. The best they can do is look at the interest rate and consider whether the mortgage term is 25 or 30 years. But the repayment frequency? That's often left in the shadow. Banks default to monthly payments, but did you ever hear that the frequency you pay can have a massive impact on your financial status and wealth plans? More frequent repayments can help you pay off a mortgage much faster. And the best part, you might not even notice it. Let's break it down. Suppose your monthly repayment is 1,000 Australian dollars, making for an annual total of $12,000. But if you switch to paying fortnightly at a $500 every time, your yearly repayment grows to $13,000. That's an extra $1,000 you've paid without even feeling it. Weekly payments, same story. And the magic lies in the fact that a month isn't exactly 4 weeks. Sometimes it's 28 days, sometimes it's 31. So if you want to be precise, your weekly payment should be $1,000 multiplied by 12 months divided by 52 weeks. This strategy cleverly takes advantage of common misunderstanding. Without any pressure, you've paid an extra month loan every year. That could get you mortgage-free about 2 years earlier. But that's not all. Increasing your repayment frequency can also cut down your interest costs. Since mortgage interest is calculated daily, splitting monthly repayments into fortnightly payments changes the game. Imagine a $500,000 loan. For the first half of the month, the interest is based on that full amount. But after you pay $500 for the first fortnight, the interest base drops to $499,500. And naturally, your interest is less, meaning you will pay off your mortgage sooner. Taking that 30-year, 5% interest rate, $500,000 loan we talked about earlier for an example. Paying fortnightly instead of monthly could save you an astonishing $86,000 in interest over the lifetime of the loan. Number 2, tax deductions. If you've recently bought a new property or just finished renovating, have you considered claiming depreciation? Let's say you have an $800,000 new property that can get you an annual depreciation of about $15,000 to $18,000. Now stay with me here. This amount gets deducted from your tax base, reducing your personal income tax. And if you're in the 45% marginal tax bracket, this could save you $6,750 to $8,100 each year. If you put the saved money towards an extra $150 a week payment on your mortgage, you can cut $200,000 in interest and be done with your loan 8 years sooner. But depreciation isn't the only card to play with. There are also interest expenses. If you have an investment property, the interest on that mortgage is tax deductible. Many savvy investors rush to pay off their primary residence while holding back on the investment property. for the same reason. But remember, it's all about efficiency. You have to weigh which option suits you best. Paying off the principal of the mortgage of your primary residence, or put it in the offset account for your home, or doing the same for your investment property. Get your accountants to calculate the numbers and then make a decision. Number 1. Now let's talk about what I believe is the best way to pay off your mortgage earlier. Find a great mortgage broker. Just like real estate agents, this profession is easy to enter but very hard to master. Some brokers might be a little too linear in their thinking. They take your documents and submit them to their go-to bank. If that doesn't work, they will try the next familiar option. They may lack insight to your unique situation, making random attempts without understanding each bank's policies. Others may only know how to write a loan for salary earners. The more experienced ones can write loans for self-employed, small business owners, or foreign income earners. The top-tier mortgage brokers, though, know the rules for family trust and self-managed superfund loan and have direct connections with management in major banks and financial institutions. You see the difference, right? And this is just the tip of the iceberg. Let's not forget about ethics. You want a broker who won't mess up with documents containing your record at the bank. You want someone who won't push more expensive loan products on you just to earn more commission, or one who continues to negotiate lower interest rates for you even 2 years into your loan. If you're not familiar with the mortgage industry, you won't notice what the brokers are actually doing. That's why we offer a one-stop solution with our Vision membership, providing property investment custodial services, including matching mortgage planning services. So there you have it. Work smarter with your money, investment, and taxes. Choose your mortgage broker wisely and watch the path to owning your home become much shorter. It's not about having more, it's about doing more with what you have. If you've made it this far, please give a like, subscribe, and share this video with your friends. Turn on the notification bell to watch new weekly videos, and follow me on social media at Real Coach Alex. Hope to see you soon. Have a good one. Bye.